News being what it is, I want to hold off just a second, beg your indulgence for a few minutes before we delve deeply into diversity and ask a few questions about things like inflation and war that are going on. Actually interest a lot of people. We have a lot of concerns. Yesterday, you said in a speech that it is time to remove the accommodation we have been providing. That means marching up to neutral and looking at whether we need to go over neutral to tighten a little bit, restrict the economy to ensure that inflation comes back down. My first thought was, what song are we marching to? But my second thought is, what is neutral? How high do you have to go and how fast do you have to get there?
Well, let me say that the song, and I'm picking up on what you said, but the song we're marching to is that we have a dual mandate: price stability and full employment. And of course, with the labor market so strong, inflation is the top of everyone's mind. And so then it's about removing that accommodation. And if you think about estimates of the neutral rate, and there are a wide range of estimates, the confidence we have in any specific estimate is not very high, but I'll just use what I think more or less is a consensus estimate, which is that the real neutral rate is 50 basis points, 0.5. And expected inflation at our target is 2% on average. So that gives you a nominal neutral of 2.5. So if you think the nominal neutral is 2.5, then marching towards neutral, as you would say, or I did say, is getting the policy rate to 2.5 at least, and then being restrictive would be moving it above that. But of course, the neutral rate of interest is it's a concept, it's a star variable, as we call it, and they're easier to talk about theoretically than they are to measure. But the measurement we have suggests that, to answer your question specifically, 2.5 is sort of the neutral nominal rate that we would be aiming for. And then if we went above that, that would be restricting the economy, not just removing the accommodation.
Well, how far above it do you think you have to go? And again, how fast do you have to get there?
So let's start with how far above it we need to go. I think, my own view is that some increase in the policy rate above neutral is likely to be required, but that's down the road in 2023. And so right now, I don't think we need to be so decisional on what that looks like. We just need to be recognizing that if inflation comes down because our policy rates adjustments are affecting inflation, because the factors that have also been pushing it up, supply chain disruptions, the weak recovery of labor supply, to get labor force participation to come back, just the general settling of the economy, people start buying services and not just goods, then we might find that just a little restrictive is just right. If, of course, those factors don't materialize and inflation keeps moving up, then we're going to have to be a little more restrictive. But I don't think it's necessary to call that today, just to be assuring the American people that we're prepared to do whatever it takes to ensure that we get price stability, which clearly no one thinks we have right now.
Well, several of your colleagues have talked about front loading. Are you in that boat as well?
I actually think the SEP, the Summary of Economic Projections that we released last week, is front loading. If you think about it in historical context, the traditional way that we've done it over the last couple of decades is you raise the interest rate, you rest a meeting, you raise the interest rate, you rest a meeting. And it's really that gradual approach that was meant to see what's going on and then make adjustments. But the SEP median was 7 increases in 2022, and that suggests quite a bit of front loading on policy. And I'll remind people, if I may, that we're also going to make balance sheet adjustments, and as early as in the May meeting, but that hasn't been decided completely yet. But that's another, that's generally considered an equivalent to at least another rate hike. And then, and this is something we often don't talk about either, we're making these adjustments at the same time other central banks across the globe are making similar types of adjustments, tightening policies. So we could get a lot of tightening in financial conditions globally, and that is something we have to think about. So I do think relative to previous periods of tightening, this is quite a bit of front loading, just as the SEP has indicated.
Well, Chairman Powell said on Monday that he's open to a 50 basis point move at the next meeting, and the market is certainly taking him at his word. Are you willing to support that?
I think the data will tell us whether 50 basis points or 25 basis points in the balance sheet is the right recipe, or 50 basis points in the balance sheet. These are all the tactics of how we get the policy rate adjusted, and the data will help guide us. So I would hate to front run those deliberations, but I will absolutely confirm what Chair Powell's confirmed for himself, which is that I have everything on the table right now. If we need to do 50, 50 is what we'll do. If we need to do 25 in balance sheet, that's what we'll do. But the data will help us determine how much is necessary. The important thing I think everybody listening would like to know is that we're committed to moving the policy rate in alignment with what the economy needs. And right now, it doesn't need all the extraordinary support that we've been offering.
What do you think the war in Ukraine is going to do to the global and U.S. economies? We had Christopher Waller, Governor Waller, on the board say that he didn't vote for 50 basis points last time because he was unsure. But Jim Bullard told me yesterday, we can't wait to find out. We have to act now. What do you think?
So when I look at and I put a couple of risks in front of people. So the invasion of Ukraine and the ensuing difficulties, first, my heart goes out to the Ukrainian people. But if you think about the effects on the economy, that it is definitely a global headwind. In the U.S., with the domestic economy, I see it as mostly a risk to inflation, further upward pressure on prices, gasoline. You already see it at the gas pumps, but also other commodity prices, which ultimately are inputs to goods that we are already finding high prices for. So I certainly think it is an upside risk to inflation. I factored that in. And I think it's a modest risk to growth, but not the kind that would produce anything like stagflation, because again, we're a net oil exporter right now. And so when prices rise, production in the US also increases and we get that offset on growth. But this is a big uncertainty shock. And then you also have this happening when it's clear that COVID is not completely behind us. In the US, we've been very fortunate. We feel like maybe we're moving to endemic, but they don't feel that in China right now or other parts of Asia or even in the UK. But particularly Asia, where the tolerance for COVID because the vaccination rates are low is just lockdowns, and that disrupts supply chains. So I think all of these factors push up inflation and have a limited effect on growth, but certainly it's material that we should think about these things.
Well, Dallas Fed researchers put out a paper that scared a lot of people yesterday that said if Russian oil stays off the market for the remainder of 2022 in the way that it is right now, that a global recession is almost inevitable. Do you disagree?
So I think it's too early to call that we're going to have a global recession. And I think it's too early to call that this is, all research is a hypothetical. You're imagining what would happen, a counterfactual, if you will, that hasn't occurred yet. So I think it's useful. Our models are very useful. Our research is extremely useful in laying out the possibilities, but the probabilities don't often match up to those possibilities. And so right now, when I look out, I see a very limited chance the U.S. will fall into a recession. I do feel that the global economy will slow. How much it slows and how much people adapt to the changing conditions that we find ourselves in, I think is still uncertain. But the bottom line is that countries across the globe are facing something really important, which is inflation that's far too high for their tolerance and for their price stability goals. And we also have these risks on the horizon, which is why, I have stated that I don't think it's appropriate to, really ratchet up so quickly that we forget about the risks out there, but rather we be data dependent. We see how the data comes in and we're prepared to do whatever it takes to ensure price stability and in the wake of all of the other challenges that we have.
I suspect if I asked you if we could reach a soft landing, you would say, yes, we can. But let me put it this way. What are the odds that we can, that the Fed won't tighten too much? That seems to be a major concern on global Wall Street.
Well, certainly I'm committed to doing everything that I can and we can to achieve a soft landing. And we've got periods of history. Alan Blinder, who was the former vice chair of the Fed, is doing work on this. It shows we've had periods of history where we've had a soft landing. And so it's not unusual that we can achieve that. But what it requires is just what you said. It requires us to be diligent about getting the right amount of accommodation for the economy. But, I'll use an analogy if you'll bear with me. And it's one that I use when I try to explain policymaking to people. If you're in a car and I'm driving and you're in the back seat and you see that we need to slow down there, you hope that I'm aware and I've got my foot on the brake and I'm slowing, but you're also hoping that I'm not slamming the brake on and throwing you from the back to the front seat, because that would be disruptive. And so a smooth landing is about adjusting the policy rate as quickly as we can to get the right amount of accommodation in the economy for what the economy demands, but not doing it so abruptly that we are disruptive in the doing. And I think the disruption can come from just moving too quickly, but it can also come from imagining that there are only a few risks out there when there are really, multitude of risks. And so that's how I'm approaching it, in a balanced way with commitment to get price stability. I really want every American to wake up and not think about inflation.
For those of you who are listening to this on Bloomberg Radio, this is the Bloomberg Diversity Summit, and we are speaking with Mary Daly, the president of the San Francisco Fed. Madam President, in August 2020, the Fed announced a new framework for its monetary policy. Let the economy run hot, let inflation rise a little bit before reacting, so that more people can find jobs, particularly minorities and women. And this is where we transition to the diversity question. First, is that framework now junk, given what's happened with inflation?
No, I actually think the framework has served us well, because, the framework wasn't just about that. It didn't just say, oh, let's run the economy hot and employ as many people as possible. What it said is we have a multitude of conditions we could face. One of the conditions was the one we'd been challenged by for the decade leading up to the framework, which is after an 11-year expansion, we were not yet able to get inflation stably up to 2%, which is our target. And we know the risks of inflation below the target are also costly. They're not just inflation above the target. So the second thing we learned is that we just didn't really know. We have estimates, but we do not know what full employment is until we experience it experientially by seeing it in wages and ultimately in prices. So you put those two factors together and we say, full employment is a broad and inclusive goal, and our target for inflation is not 2% a perceived ceiling, it's 2% on average. And so those are two things that we held to. So then you roll into the pandemic, and what it allows us to say is, look, to all the consumers and businesses out there, we are committed to ensuring that inflation is 2% on average and that full employment is met. We eliminate shortfalls. And so here we are today. And we have eliminated shortfalls in employment. I think if you're a firm out there, you recognize there is not a shortfall in employment. There's a shortfall in numbers of people who want your jobs. And so that goal has been achieved. And we have inflation that's too high. But if you trace back the reasons of inflation being too high, it doesn't trace back to the framework. It traces back to supply shocks on the supply chain, the rotation of all of us to buying, exercise equipment and home improvement goods rather than partaking in vacations and other services, and the fact that we just lived through a global pandemic and we're still struggling with it. So those are things that the framework's well equipped to do, because we now say full employment, we have a strong labor market, and we're committed to getting, using our tools, which we've always had. The framework didn't tie our hands, using our tools, the policy rate, the balance sheet reductions, to bring inflation back to our definition of price stability. So I see that as serving us well. And importantly, the employment recovery has been broad and inclusive, and something that I think we'll look back on and say that was a success after a global pandemic.
Well, the way monetary policy works, you raise interest rates, that slows demand, which slows investment, which slows or constricts hiring. So what do you say to blacks or Hispanics or Asians or women who would say, yes, we have an inflation problem, but it's my job you're talking about?
Well, what is true is that the rates of unemployment, the rates of quits, all the things we can look at have wage growth. That's been going up most rapidly for those at the lowest part of the wage distribution. Blacks and Hispanics and women, the unemployment rates for those groups have been falling, for Asian Americans falling, and really starting to narrow some of those gaps. In fact, we're seeing things in the labor market. I've been a student of the labor market for my entire career. We're seeing things in the labor market that we often don't see until very late in an expansion. And so the good news is we're already seeing those things. The important question for me, as I think about this from a policymaker's perspective in an equity summit, is, we have to be nimble in our policy. So right now, inflation is top of mind because inflation is a regressive tax. The very people we care a lot about in terms of equitable inclusion in the labor market are the very people who are being most ill affected by the rapid rise in prices. So these are intertwined goals. They're not trade-off goals. And intertwined goals means that full employment depends on price stability. Price stability depends on full employment. And what I tell all of the groups who you just named and anyone else who asks is that achieving one achieves both. If we do them together, we'll get an economy that's sustained. And we do know this, that for the groups that have been historically less advantaged in our economy, a sustained expansion is the best remedy to many, many of the problems that they face.
I want to broaden out the discussion of diversity now, but before I do that, I want to help familiarize some of our viewers with maybe a little bit about your story. You came from a broken family, dropped out of high school, ultimately got a GED, then went and got a bachelor's, master's, a PhD, ended up in the research department at the San Francisco Fed, then became the research director, and in 2018 became the president of the San Francisco Fed, succeeding John Williams. You're the second female president for the bank and the first openly gay woman to lead a central bank. So you know a lot about diversity, which sets the stage for a few questions here. And I want to start with diversity at the Fed. The system, not necessarily your bank, but the system has been heavily criticized for being a bastion of white males from privileged educational backgrounds. Can you diagnose the problem? How has that affected policy and ultimately Americans who are being affected by the Fed's decisions?
Well, so let me start by saying something that I hope all of us would agree to. I certainly hold this as a North Star, that we make our best policy decisions when we reflect the people we serve. So this is ultimately the public's Fed. And if we have the people around the table, and I importantly want to make a distinction between what I would call decorative diversity, where you have a lot of different people around the table, but only a few people have voice. So we have to have a diverse group of people, but we have to have a diverse group of people with voice who can help spot problems and broker solutions and come up with ideas that create the best policy for every American. Now, the question is, why have we historically not had that kind of diversity? Why have we not represented the people we serve in terms of our research department? So let me talk about economics. Economics is a profession that if you compare us to some other of the scientific professions with the STEM professions, we actually have a poor track record in terms of diverse groups taking up and getting a PhD. And since it requires a lot of technical expertise to be in the research department of the Federal Reserve, then we've ultimately felt like, okay, we can't do better. But the truth is we can do better. And you can do better on a variety of fronts. First, you could recognize that simply having a macro or a finance degree isn't the only way you can contribute in monetary policy. I'm a microeconomist studying labor economics. And when I came to the Fed, there was a question about whether I'd ever be allowed to even go to the FOMC. And here I am. And I think I make a contribution. So I think, that proves a point that is broader than me. It proves a point that different ways of looking at things, if you're not in the traditional fields, can be helpful, but those are also fields that have more women, more minorities who partake in them. So that's one thing. The second thing is we can change the pipeline. The Federal Reserve is one of the biggest purchasers of economists in the US marketplace. And we are actively working as a system to try to change the pipeline, get young people to think about PhDs or economics as a degree that they would like, go out and talk to people. Ultimately, Mike, I'll say that I've always compared it to this. economics is a little bit like the people, I know you've all been to these houses where they invite you to their house, and then they tell you how they'd like you to behave so that they feel comfortable having you there. And I want economics to be the profession that we all have been to these houses as well. People invite you to their house, they open their doors, they can't wait for you to bring your full self to it. And then they may learn something but they just want you to be who you are. And economics has not traditionally been that profession, but I know that we can be. And the Federal Reserve and all my colleagues, we're devoted to trying to make that home everybody wants to go to.
Well, it's interesting you say that because you've told a story about how in some graduate schools, many of the schools have all kinds of welcoming efforts to try to get people into the schools, and economics hasn't done that. And one of the reasons we may see fewer minorities and women is they don't feel like it's a welcoming profession and that they can advance. How do you change that?
Well, I think we have to get out there. I implore schools to do this, and some schools are doing this. But in the absence of being able to implore people to do it, we'll just do it. So, my colleagues and I are here in San Francisco, but elsewhere, we're just going to schools ourselves and talking about the value of being in economics. And we're starting, we just had an essay contest to bring in a young researcher to have that person work here with us and invest in them. Now, we're piloting a variety of these projects, but getting it to scale is the harder part, and it's going to take more people than us. But I definitely think this is possible. But what would make me very happy is if I walked onto the campus of any university in the United States and I saw gigantic welcoming signs like they have in computer science saying, "We want you, please come to our department for a mixer." And think of all the young people of all kinds, maybe from a rural area. I didn't even come from an Ivy League school. And so, that was not very inviting for me. But boy, what if we change that equation? That would be tremendous. So I'm an optimist by nature. So I'm eager to work on these things. But I do think it's going to take more than just optimism. It's going to take intention. It's going to take changes in practices. It's going to take the idea that if we were entrepreneurs and our pay depended on it, we would create a 5-year plan and we would have deliverable improvement in 5 years. And that's the mindset we have to bring to this.
Now, you've done some studies that show this is not just the right thing to do, it's the economically prudent thing to do. I think you did a research paper that suggested that it costs the U.S. economy, this lack of diversity, about $3 trillion a year, 70 trillion since 1990. This is a lot of money.
It is a lot of money. And the reason we did this paper is that, the issues of equity and inclusion and diversity tend to, get relegated to a fairness debate or a social issue, but actually they're important for our economic fortitude, our competitiveness as a nation, the ability I think all of us want to have, which is to give the next generation a better and brighter future than the one we inherited. And if we're leaving this much talent on the table, we put a dollar amount on it. That's just putting a dollar amount on the literally millions of Americans that we leave their talents on the table. Either they have barriers that don't allow them to go into the things that they'd be best at or the things that they're most interested in, or we simply don't even employ them. They just aren't part of the labor market. And so the point of the work was to show that an inclusive economy is a productive and competitive economy that has a bigger pie that can then be divided across a variety of us. It's an evolution of that famous phrase, "We all do better when we all do better." I think this is beyond fairness. This is really about our livelihoods and our future.
I want to ask the sort of the how did you do it question, and that is that if I did a survey, I think it would be very hard to find any boss of any color who would say, "I'm not going to hire a person because they're a minority or because they're a woman," but they don't get hired. So how does that change? How did you manage to work your way up?
Well, that's a good question. And so the way I worked my way up, if you will, is that, I was really fortunate that people mentored me, sponsored me, talked to me. I've said publicly, Janet Yellen is one of my great mentors. So what did that mean? It meant that Janet was willing to sit down and have coffee with me. Or if we were at an airport waiting for a plane, because we had traveled together, she'd just start talking to me about how she did it and what she did and things to think about and things to do. And that's that's really just a series of conversations with a variety of people that really helped me get to where I am. And then the question is, do we want to leave that to chance? So, someone once asked me, what do you take from having made it? And I said that we have a problem where we're actually, the fact that we talk about me means that it's unusual. And if it's unusual, it means we're leaving lots of other people on the table. So behind the scenes. So one of the things that we've done in San Francisco, which we're working on this, but we're hoping that other people will join and we'll get best practices, is we launched something we call the Framework for Change. And the Framework for Change is, how do we get in there the elements of that equity that actually lead to outcomes like myself, so that we can scale my experience. And it's about changing processes. It's about changing posting requirements so that you have to post all the jobs. It's about giving people interview help. It's about making sure we understand that we might actually only, often choose people who look like us, whatever they are. But, someone asked me, wouldn't it be great to have 1 million of you? And I said, probably not. No, we don't want 1 million Marys. We want lots of people with diverse views, but we only can do that if we have programs, practices, and intentions that say what is true, which is we make the best policy when we have a diverse set of views and everyone has a voice.
Now, that all sounds good, but, and you know this very well, there are a lot of Republicans on Capitol Hill who say, great, but that's not the Fed's job. How do you respond to them?
So our job, which Congress gave us, is to help build a sound payment system, safe and sound payment system, a safe and sound financial system, along with other regulators, and execute the dual mandate goals of price stability and full employment to the best of our ability. And to the best of our ability, serving every American means that we have to have a diverse set of voices around the table. And if those are my inputs, then I have to be committed to ensuring that I deliver that. And delivering that means I have to be thinking about equity issues, diversity issues, inclusion issues, voice issues. And importantly, what I've learned in doing that is that these things are so material to our economy that it is absolutely squarely in our mandate. And those are the reasons why. And, I talk to various leaders of all different groups, business leaders, congressional reps, community members, and we can all align around one thing: that we understand that when you are a public servant and you serve every American, it means you have to hear from every American. So that is what I do.
Let me slice a little bit back into the Federal Reserve, and that is a question about over the past couple of years, there's been an issue with women not returning to the labor force in the same way that men did after COVID. How much of that is really because of childcare or medical care for others, and how much is it maybe a secular shift in the way women think about working in the same way we had in the 1990s when so many joined the labor force?
Well, it's hard to parse out those changes in culture from changes in constraints. But one of the things that you learn early on as an economist, it's like a little thing that we are taught, is that, using culture or tastes and preferences is the last refuge of a scoundrel. And they really do teach you that. But what is meant is that, we can always ascribe what we see to differences in culture, differences in preferences, et cetera. But it often is differences in barriers, differences in constraints, differences in opportunities. And so with women, as a group, I'd rather them prove to us that they don't want to come back rather than assume that they don't want to come back. And right now, when I look at what women in particular have to deal with, but parents more generally, people who care for their own parents, is that we're not completely past COVID, and the infrastructure that many have come to rely on to take care of their children, school, is in session. But episodically, you have to Zoom school your children. And so that idea that we're all through it, and if they're not back, they're not coming back, I think it's very premature. So I'd like to give every woman out there who's on the sidelines right now the opportunity to have a full choice. And one of the ways that we might find our world evolves is that instead of having to choose 40 hours or nothing, we can have more divisible work and work part-time and come in and out of the labor force without penalty, have careers, raise your children, do all the things that people want to do, and find ourselves with more capacity in the economy, not less. But my own view is it's too early to declare anything is true. And the best way to find out is create a sustainable economy that works for everyone.
Before we go, let me ask you one last question here about how we measure results. I can look at a picture, say, of your staff at the San Francisco Fed and say, yeah, there's more women, more blacks, more Hispanics, et cetera. But if I'm someone on the street, just an ordinary San Franciscan or a person in your district, how do I know that things have changed for me?
Well, if you're an ordinary person, as you say, right now, I think what you would like to know is, do the things that I care about feel like they're being talked about by Federal Reserve officials? And what you worry about right now is inflation, and you worry about your jobs, and you worry about, is my bank sound, and can I get cash when I need it? And what I think people are seeing is that not only are they getting those things, are we talking about those things, but when they look out and they hear who's talking about them, they see people who are more likely to look like them than they used to be. And I think that's important. You know, when we have tours and people come back into our bank, which hopefully will happen soon, I like people to be able to come into the bank from off the streets of San Francisco, you know, wherever they're coming from, especially school children. And I want them to see people who look like them, who come from their area, whether that's a rural area, an urban area, Black, white, Hispanic, women, tall, short, introverts, extroverts. I want them to be able to see that they could possibly be here one day. And I think that's the guarantee I'd like to make to, you know, the people in San Francisco, the people in all of the district states. I have 9 Western states, right? And it's a big district. And I really want everyone to see that when we talk about something, I've heard from their communities, and I'm speaking in a way that's knowledgeable about that with an understanding, as opposed to just using introspection and saying what I think they might feel. So that's the guarantee that I have. That's what we're trying to accomplish. And I think it's an equity summit. It's important to say, you know, we're not there yet. I would hate for people to go away thinking, well, we're a victor here. We are on a journey. And that is what it looks like. It looks like trying every day, understanding when you've fallen short, and doing better the next day.
Mary Daly, thank you very much for joining us here at the Bloomberg Diversity Summit. She is the president of the San Francisco Fed. I'm Michael McKee. Thank you, everybody, for joining us today.